In. We are now live. Great. Hey, good morning and welcome to the Shenkman Private Client Group Accountant Attorney Windsor webinar series. This program is entitled Important Medicaid and Elder Care Update, New Major Changes to New York's Home Care Program. For those who don't know me, my name is Jonathan Shenkman. I'm a financial advisor, portfolio manager, and an accredited investment fiduciary at Oppenheimer based in New York City. The goal of all my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 15 to 20 events that I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in Barron's, CNBC, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, and many other periodicals. My most recent piece was published in Forbes and is entitled, Don't Let Confirmation Bias Derail Your Finances. After the program, I'll send out a link to this piece and a variety of other periodicals where I publish my work. Today, we're privileged to hear from Elizabeth Forspan. By way of background, Elizabeth is a partner with Forspan Klear LLP, a Long Island-based law firm. She practices in the areas of elder law, trust and estates, and taxation, and regularly assists clients in achieving their Medicaid planning goals in a tax-efficient manner through practical and considerate planning techniques. Elizabeth speaks throughout the United States on various aspects of elder care planning, tax law, and estate planning, and has lectured on the income taxation of trust and estates for the National Business Institute, as well as key elder care planning issues for the New York State Society of CPAs. She has been named Super Lawyer's Rising Star in the area of estate planning and probate multiple times, has been featured in New York Magazine, Market Watch, and has been quoted in the New York Times. Today, Elizabeth will be speaking on Important Medicaid and Elder Care Update, New Major Changes to New York's Home Care Program. And with that, I'll turn it over to Elizabeth.
All right, Jonathan, thank you so much. And thank you all for joining us today. I am really thrilled to be here. I thank Jonathan. I thank all of you. My relationship with Jonathan and my partner, Jay, and my relationship with Jonathan has been tremendous. He's been incredible for all of my clients. And it's an honor for me to be here today with all of you. I wish that we were in person like last year, but God willing, next year we'll be together. So probably because of something I did, I'm not able to control the slides today, but Jonathan is going to do that. And we will absolutely make the slides available to everyone. So what we're going to talk about today, and we have a very short amount of time to cover this, are the new changes in the New York Medicaid program. Now, a lot of the concepts that we're going to talk about today are federal concepts as well, but we're going to specifically focus on the New York changes because they are dramatic. So, and we're going to focus on Medicaid in the home care setting. That's community-based Medicaid. So, Jonathan, if you want to go to the next slide, that would work. Awesome. So when we talk about Medicaid, we're talking about today, we're talking about paying for the cost of long-term care. We are not talking about the Medicaid that's for health insurance for young and relatively healthy people. We're talking about Medicaid for either payment for a nursing home or to have a home health attendant in the home. So that's the type of Medicaid we're talking about today with a focus on the home care aspect. So when we talk about long-term care planning, we have to think about how are we going to pay for long-term care when we get older, or when our clients get older, or when our loved ones get older. And we know that there are a number of different options. You know, we could pay privately for care. Now, private pay care is pretty expensive, right? We have nursing home care in our area, and I'm joining you from sunny Great Neck, New York today, from our Great Neck office. Nursing home care in our area is going to be about $18,000 to $22,000 a month on average. So the private cost of care is quite high. Home care is about $30 an hour. So I don't have to be a math wizard like Jonathan to know that $30 an hour, if you require 24-hour care, particularly if your loved one requires a split shift, which is 12 and 12, that's a lot of money. And so that's quite expensive, and many people don't have the resources for that. And many people have, a lot of our clients do have some money, but, paying privately that way would really drain them of all of their resources in a very short amount of time and not leave anything over, not for their children and grandchildren. That's not really the focus of most people's planning. The focus of most people's planning is they want to have some left over when they're on Medicaid to pay for an extra aid, or for example, someone's in a nursing home. We don't want them to only rely on, if God forbid someone needs to be in the nursing home, we don't want them to only rely on the facility. We want to bring in a private aid to help them get dressed in the morning, to give them breakfast, to give them some sort of quality of life. And so we want to have some resources, some assets left over for our loved ones to pay for those types of things to enhance their quality of life. So private pay care, very, very expensive, and not an option for a lot of people. We also have to think about the assets that we want to protect, like the home and the retirement accounts and other assets. And we'll talk about that. Another way to pay for long-term care is through long-term care insurance. I am, and I've said this many times before, and I'll say it again, I am a huge proponent of long-term care insurance. Actually, Jonathan has helped a number of my clients in that regard. And so long-term care insurance is a wonderful option. The issue sometimes is that the individual, by the time that they come to us, or if they come to Jonathan and say they want long-term care insurance, they may be too old and the cost would be too expensive at that point. Maybe they have certain health considerations which make it impossible for them to acquire the long-term care insurance. And oftentimes what we see is clients do come to us and they do have a long-term care insurance policy, but it's not sufficient to cover the cost of care. They may come to us with a policy that pays $150 a day or $200 a day. Now that could go a long way towards home care, but for nursing home care at $600 a day, that's really not going to cover. So at that point, when they come to us, they have to do some additional planning to help pay for the rest of the care. And so long-term care insurance is wonderful. And for our younger clients and for those of our clients who can pass the medical underwriting, we absolutely recommend that people look into long-term care insurance. I have a type of long-term care insurance just because of the nature of the business that I'm in. I got it when I was, I think, 33 years old, which may be a little atypical, but this is what I see every day. So we're very big proponents of long-term care insurance. And that's something that Jonathan really can help a lot of people with and has done so, and thankfully for so many of our clients. We have the option of reverse mortgage. I'm not even going to touch upon it today. You can watch the commercials with Tom Selleck and learn all you need to know about reverse mortgages. And then the other option for paying for long-term care, for an aid or for a nursing home care, is support from family members. Now, that's not a good option. We don't want our children to have to decide between sending their children to a private college and paying for our long-term care. That is not generally a good option. And particularly when you're looking at $250,000 or $300,000 a year in the cost of care. Even our children, even our clients' children who are successful and what we would otherwise consider wealthy, that could be a tremendous drain upon their assets and their income. So that's not a good option. What about Medicare? Does Medicare pay for the cost of long-term care? No. And this is a common misconception. Medicare is a wonderful government program, and I'm so happy that we have it. Medicare is health insurance for the elderly, right? You turn 65, you're about to turn 65, you got to sign up for Medicare a month before, 2 months before. Wonderful. That's for health insurance. If someone goes into a nursing home or if someone needs an aid in the home, Medicare is not going to pay for that. Now, we do know that if one of our loved ones goes to the hospital, maybe they have a surgery and they have to go to rehabilitation after, that Medicare will pay for a certain number of days. Many of us know that 100 days, which the 100 days, it's there, but it's not necessarily going to be there. So yes, Medicare will pay for a maximum of 100 days in a facility, but for rehabilitation, and may not even pay that much if you're not progressing or if your loved one is not progressing in their rehab. So Medicare does not pay for the cost of long-term care. So the program we're looking at today is Medicaid. Okay, we're looking at the Medicaid program. So Jonathan, let's move on to the next slide and one beyond that even. Okay, so what we're going to talk about is Medicaid planning, and I really want to focus on the dramatic changes that have occurred this year, particularly in New York. When is the perfect age to start Medicaid planning? We tell people in their mid to late 60s. And the reason for that, as we're going to see, is that there is a 5-year look back for nursing home Medicaid. So the whole concept of the Medicaid planning is that we do divest ourselves of certain of our assets, not all of our assets. We divest ourselves of certain of our assets far enough in advance so that we could one day qualify for Medicaid if we're going to require long-term care. All right. And so because of the 5-year look back, because when you apply for Medicaid, the Medicaid program not only looks at what assets you have at that point, remember, you need to be under a certain asset threshold. So the Medicaid program not only looks at what assets you have when you apply, they look at all the asset transfers that you've made within the last 5 years for institutional Medicaid. This is for nursing home Medicaid. So if you've made transfers within the last 5 years, they count those non-exempt transfers as if you still have that asset. So if you transfer $500,000 4 years ago, they're going to count it as if you still have that $400,000 on the date of your application. So that's why we tell people that mid to late 60s and early 70s is a great time to do the planning, because statistically you will have 5 healthy years before you would ever have to go into a facility. Okay, so that is why we tell people to do planning at that stage. Now for home care, it's a little bit different, although it's kind of becoming the same now, which is what we're going to touch upon. Okay, so we have an asset threshold in order to qualify for Medicaid, which I am going to speak about very shortly. And the asset threshold is an amount that you have to have under. You cannot have assets in excess of that amount, because remember, Medicaid was designed as a program for the indigent. It is not currently being used, as we all know, as a program for the indigent. Okay, Jonathan, why don't we go to the next slide? Okay, now we have the 5-year look back, right? 5-year look back, very important. We just mentioned that in order to qualify for Medicaid, we have to have under $15,900 in non-exempt assets, which I'll talk a little bit more about in a few minutes. And so we have to plan 5 years in advance, right? Hold on a second. Now we have something called a 2.5-year look back. What does that mean? Sounds good, right? 2.5 years less than 5 years? No, not good at all. The 5-year look back still applies for institutional Medicaid, right? You apply for Medicaid, they look back at all transfers that you've made within the preceding 5 years. But for home care, that's community-based Medicaid, historically in New York, and I mention New York because most other states have a 5-year look back and have had a 5-year look back for community Medicaid also. But New York, which is the single most generous Medicaid state in our entire union, even now after these, what I would call horrible changes, New York never historically had a look back for home care, which was wonderful. What did that mean? Clients would come in, they're ready to get on to home care. They need an aide for mom or dad in the home. We transfer all their assets in January, and guess what? February 1st, they'd be eligible for community-based Medicaid for home care. Financially eligible, no look back, not 3 months, not 5 years, not 1 month. It is the first day of the month following eligibility. You get under that, you transfer your assets. You get under that asset threshold, you get onto Medicaid. It was wonderful, right? So that's how many people were planning. Many people would say, you know what, I'm never putting mom or dad in a nursing home, which by the way, we all believe, but is not actually the case in many situations. As you know, before COVID, you'd walk into the nursing homes and all the beds were full. Why were all the beds full? If everybody sits at our conference room table in the office and says, I'm never putting mom and dad in the nursing home, or if the clients themselves look at us and they say, Jay, Liz, we're never putting mom in a nursing home, why is it that the nursing home beds are all full? Because the reality of the situation is that mom or dad goes in for surgery, they break a hip, they fall, whatever the case may be. They get the surgery, they're in the hospital for a couple of weeks, 2, 3, 4 weeks, and what happens? They can't walk, right? They're sitting in a bed, they can't walk. So they have to go to rehabilitation. They have to get the rehab. And unfortunately, so many times what we see is they cannot get out of rehab. And then rehab turns into nursing home. It's the same building in most cases, but you move to a different floor and it becomes a long-term care stay. So it's not that the family members were lying when they said that they were never going to put mom or dad in the nursing home. It's just the reality of the situation for so many of our loved ones and for so many of our clients. So, many clients would say, I'm not going to do the 5-year look back planning because if mom or dad ever needs care, they're going to get care at home. And if they need care at home, I'll just transfer the assets on January 31st, and then I'll apply for Medicaid on February 1st. Doesn't work that way, by the way, even in the good old days. So, that was an approach that many people have. Well, now, folks, we got a big problem. Okay, we have the 2.5-year look back for home care as well, which I'm going to get to in just a minute. Jonathan, we can move over to slide number 6. Okay, before I get to this new major change in Medicaid, I just want to give a little bit of a background on the asset and income rules for Medicaid so that we're all on the same page and we understand this. In order to qualify for Medicaid, whether it's nursing home Medicaid or community Medicaid, right? Nursing home or home care in New York, the asset threshold is $15,900 in non-exempt assets, which means that our clients, when they apply for Medicaid, have to have assets lower than $15,900 in New York. In New Jersey, the asset threshold is $2,000. And in many other states, the asset threshold is $2,000. And the rules are significantly more difficult and burdensome in other states, even now. Okay? So in New York, the Medicaid applicant can have no more than $15,900 in non-exempt assets. I'll talk about what exempt assets are shortly. And the spouse in the community can have about $130,000. That's called the Community Spouse Resource Allowance. But in almost every situation, we would do what's called a spousal refusal, where the community spouse, the healthy spouse, is saying, I refuse to pay for the cost of my spouse's care, and therefore you can't look to my assets for purposes of determining his or her eligibility. Now, a spousal refusal is not a barrier to eligibility, meaning the Medicaid applicant will get onto Medicaid, but after he or she does, Medicaid is going to go to the spouse and ask for some sort of contribution. Now, that's okay, because the contribution that the community spouse is going to make towards the cost of care is far, far less than what the private cost of care would have been. So in almost every situation where we have spouses, we do what's called a spousal refusal. And I will actually talk about how spousal refusal was impacted with the new change in the law. Okay, back to the income rules now. If you're in a nursing home, right, we have asset rules, but we also have income rules. In a nursing home, guess what, folks? The Medicaid applicant can only keep $50 a month. $50, that's it. The rest of his or her income goes to the nursing home and Medicaid kicks in after that. However, if there is a spouse in the community, we have something called the minimum monthly maintenance needs allowance. And if the spouse in the community has very low income, we can take some of the money, some of the income from the Medicaid recipient and shift it towards the healthy spouse. Okay, but that level is very low. It's slightly above $3,000. Okay, now, so we have a bunch of questions, by the way. I just want to say, and Jonathan reinforced this with me because I tend to go off track and answer questions. I am not going to answer questions now, but everybody, please, on the first slide and on the last slide, my email address, eforspan@forspanclear.com. Please email me. So the community spouse resource allowance, the amount that in assets that the community spouse can keep is $130,380. And the community spouse can keep income up to about $3,200. It's $3,259.50 a month in income that the community spouse, the healthy spouse, can keep. Okay, now let's talk about the 2.5-year look back. Okay, remember we had the 5-year look back for nursing home Medicaid, but now we have this really horrible thing called the 2.5-year look back for community-based Medicaid. Okay, Jonathan, the next slide, my friend. All righty. So we have the new home care rules, which of course, required that I put in an exclamation point on this slide because this is a tremendous and what I would argue incredibly negative and very impactful change in the Medicaid rules, which we all need to know about, and we need to plan accordingly for our clients and our loved ones. The old days, they are over, my friends. We can no longer say, I'm not going to do transfers. We can no longer say, I'm going to wait until mom or dad needs home care. Now we actually have to do advanced planning, both for nursing home care, but also for home care. So what happened? What happened here in New York, in our great state, in the middle of a global pandemic, the likes of which we've never seen before, in at least 100 years? In the middle of a global pandemic, New York State and the governor signed the 2021 budget. And in the 2021 budget, which was adopted on April 1st of last year, April 1st, 2020, just a few weeks after we went into a major lockdown, they imposed a new 2.5-year look back for community-based Medicaid. Okay. Now, there was some good news. Okay. So what does that mean? That ultimately, not yet, but ultimately, when you apply for home care, to have an aide come to your house to take care of mom or dad, Medicaid ultimately is going to look back 2.5 years on transfers. Any transfers that you've made within the last 2.5 years, those are non-exempt transfers, those will count against you. And those will create a period of Medicaid ineligibility where mom or dad is going to have to pay privately for the cost of care. Okay? Just like nursing home care, only it's not 5 years, it's 2.5 years. Now, the good news is that because of COVID, this could not take place immediately. Because with the federal stimulus program related to COVID-19, which has been extended multiple times, there was something called the maintenance of effort requirement. And so what that means is that the eligibility standards and the procedures for the states cannot be more restrictive than what they were on January 1st, 2020. So in essence, the federal stimulus made it so that the states could not restrict their Medicaid programs in the period that they were receiving federal funds. Okay? So that is it's a glimmer of hope here. It's a silver lining in this horrible, horrible new rule. And so we have that. So even though the budget passed on the 1st of April last year, this has not exactly taken place. Okay? Jonathan, let's go to the next slide so I can explain how this is going to work. And this is really where the rubber hits the road here. Okay. So you see, I have a lot of things crossed out here, and that's not because we made mistakes or because we accidentally sent this to you folks in track changes. The reason why we have all these changes is so that you could see how many times things have actually changed. So they had said, because of the maintenance of effort requirement, because they couldn't restrict the Medicaid, what did they say? They said, okay, we passed the budget in April, but it's not going to take effect until October 1st, right? October 1st, 2020. So what did we have between April and October 1st, 2020? We had our busiest season ever. Why? Because everybody was rushing to transfer all of their assets. It's the same thing in a very different way that we just experienced in our Trust and Estates Department, right? It's almost the same thing we just experienced in our Trust and Estates Department before the election, where everybody was very nervous, and then before the end of the year, they were nervous about that our estate tax exclusions were going to go down, and they were going to be made retroactive to October 1st, which we still don't know, but which probably is not going to happen. The same thing, the same idea. Remember, the end of 2012, everybody's rushing to transfer assets because they think the estate tax exclusion is going down to $1 million. Of course, we know that with the American Taxpayer Relief Act of 2012 that took place in 2013, that didn't happen. And then we've had it further extended. So we deal with that in the trust and estates world. We also deal with that in the Medicaid world when there's a Medicaid change. Between April and October 1st, everybody was rushing to transfer assets because the rule couldn't apply at that point, okay? So everyone says, I'm going to transfer my assets now, because if I transfer assets now before October 1st, right? October 1st, 2020, then the 2.5-year look back is not going to apply. And that was true. And that is still true for any of our clients who were lucky enough and smart enough to transfer their assets to a Medicaid trust before October 1st, 2020, guess what? The 2.5-year look back is never going to apply to them. But what about now? What do we do now? Well, they keep extending the date that this is going into effect. So until about a week ago, we were working with the assumption that it was going to be April 1st. They had changed it from October 1st to April 1st. Now, what does that mean? It meant that for any Medicaid applications that go in after April 1st, there will be a look back for applications that go in after April, but it will only go back to October 1st, right? Any transfers prior to October 1st will not be subject to a look back or a penalty period. Now they're telling us, and this is not 100%, this is 99%, because our committee, the Elder Law Committee with the New York State Bar Association, we are in direct contact with the Department of Health, and they are telling us that the April 1st date, again, because of the maintenance of effort requirement, is likely to be pushed to July 1st. And what does that mean? Let's work with July 1st now. What does this mean? This means that if you apply for Medicaid for home care after July 1st, there will be a look back. It's a look back that's going to be phased in. But what if you apply for Medicaid before July 1st, for community Medicaid before July 1st? Well, if you apply for community Medicaid before July, definitely before April 1st, and 99% sure before July 1st. If you apply for community Medicaid for mom or dad or for your clients before July 1st, there is not going to be any look back. Okay, there is not going to be any transfer penalty for any assets that were transferred, even if they were transferred after October 1st. Okay, however, if you apply after July 1st, that's extremely problematic. There is going to be a look back. So how does the look back work? And what should I do now? Okay, what is the moral of the story? The moral of the story is it's too late to meet the October date, right? Remember, if you transferred assets before October, no look back, never going to be a look back for home care. But what about now? What about now? Should I apply for home care for mom or dad now? Well, I would say that if you think that mom or dad, or if you think that your clients are going to need home care within the next year or two, you should be applying for home care. You should be transferring assets now, doing a trust now, transferring assets now, and applying before July 1st. Right now, we have so many clients who we were a week ago or 2 weeks ago working under the assumption that it was April 1st. We have so many clients that are transferring assets now and applying for Medicaid right now, because if they apply right now, there's no transfer penalty, right? There's no private pay. They're going to get onto Medicaid. Now we're telling people, if you apply before July 1st, if you think that mom or dad is going to need care within the next year or two, absolutely. You should be applying before July 1st. You should be transferring assets and applying before July 1st so that they will never be subject to a look back and there will be no penalty. Okay? So in my next few minutes, I want to just move over to the next slide, Jonathan, number 9. This is how it works. In New York City, and this is different in every not county, but we have regional differences, very slight regional differences. But let me give you an example. In New York City, for every $13,037 in non-exempt assets that are transferred during the 2.5-year look-back period, there's going to be a 1-month look-back, right? So if you transfer $130,000 within the look-back period, that's 10 months of ineligibility. It's very similar to what we have historically seen in the nursing home situation, right? You apply for nursing home, they look back 5 years, any assets that you've made, non-exempt assets and non-exempt transfers that you've made, that's going to create a penalty period. Okay. Now, this is, again, the first time that New York has had a penalty period for home care. Every $13,000 you've transferred, that's 1 month of ineligibility. 1 month you're going to have to pay privately. Okay. Next slide, please, Jonathan. Spousal refusal, still there. This was a wonderful, wonderful thing because we thought that maybe spousal refusal was going to be on the chopping block. Thank God it was not on the chopping block. Spousal refusal still stands. Okay, Jonathan, next slide. Okay. Again, if we're going to have another extension of the maintenance of effort, which by the way, we actually just did on the federal level, and we don't know yet, it was extended until the end of the year. So we don't know if that means that the new Medicaid rules are going to be pushed to January 1st, 2022. We're not there yet. We feel very confident that the effective date is going to be pushed to July 1st. This is the slide. The next slide is the one that I'm going to end on because I want to explain to everybody how the look back is going to be phased in. It is not going to be 2.5 years right away. Okay. So this is how it works. For any assets that were transferred before October 1st, 2020, no look back, no transfer penalty. You're great. But if you haven't transferred assets before October 1st, then it will be subject to a penalty period if you apply anytime within 2.5 years, right? So if you apply in July, let's say July 1st, you missed the boat, you applied, you didn't do it June 30th like Elizabeth told you to do, you applied on July 1st, okay? There's going to be a 9-month look back. Why 9 months? We go not back to October 1st. October 1st is the effective date. Every transfer that takes place after October 1st will be subject to a penalty unless you apply before July 1st. Folks, you're hearing why it's so important to apply before July 1st. If you apply January 2022, go back to October 1st, 2020, 15-month look back, and so on and so forth until we hit April 1st, 2023. When we hit April 1st, 2023, that's when the full 2.5-year look back is fully phased in. Okay, folks. So it is 9 o'clock. What I do want to say is, what is the moral of the story? The moral of the story always is we got to help our clients. We got to make them aware of these new rules. We need to make them understand that it's not the good old days anymore. They need to do a Medicaid trust. They need to transfer their assets. They need to transfer their home, because I didn't even get to talk about that. The slides are going to be available. Jonathan is going to send them out. The homestead exemption. How is that going to apply under the new rules? There's a lot of unknowns here. There will be a lot of exempt transfers. You will be able to transfer a lot of your assets, and those transfers will be exempt, just like in the nursing home setting, but you got to understand that. So moral of the story is, we got this new rule. It's going to be tremendously impactful. So we need to make our clients aware of it, and we need to help them transfer their assets and also apply for Medicaid if they need to apply for Medicaid, and make them understand what's going on. So I thank you all. I wish that everybody stays healthy and happy. Of course, we always want to stay happy. And I do hope that next year when we do this again, God willing, we'll be together in Jonathan's office at Oppenheimer.
Great. Thank you so much, Elizabeth. There's a lot of unpack here, and we could probably spend hours and hours on this. So if anyone does have any specific questions, feel free to reach out directly to Elizabeth or myself where appropriate. I'll include her contact information in the follow-up email to this program. As I mentioned at the onset, the goal of all these programs is to stay up to date on timely wealth management related topics and to collaborate where appropriate. I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. 3 more quick items before I let you go. The first is the results of last month's poll, which was, in light of the Democratic sweep, are you more bullish or bearish on the markets and the economy, or will it not have an impact? Approximately 45% of you think that it won't have an impact. Approximately 27% have a bullish outlook, and 25% have a negative outlook on the market and the economy. Second, immediately following this program, there's another one poll question. The question is, which area of financial planning do you see most concerned, do your clients see most concerned about? Their investments, taxes, retirement, long-term care, or estate planning? And I'll be sure to share the results of that poll at my next program, which brings me to my last item. My next webinar is on Thursday, February 11th, entitled Foreign Ownership in U.S. Residential Property: Tax Pitfalls and Structuring Solutions, featuring Eli Akavon, Senior Counsel at Norton Rose Fulbright, based in New York City. Tomorrow, I will send out the registration information to this and all of my upcoming programs, and I hope you can attend. With that, this concludes today's session. Please stay safe and healthy. Have a wonderful day, everybody.